What if I told you the most powerful economic decisions affecting your life, your mortgage, your credit cards, even your job, are being made behind closed doors by people who rarely tell the full truth? Welcome to the secret world of interest rates and the Federal Reserve. This isn't just about finance, it's about control. In the next 30 minutes, you're going to discover what the Fed doesn't tell you about interest rates. We're pulling back the curtain on the quiet mechanisms that shape everything from inflation to recession risk. You'll learn how to read between the lines of Fed statements, what interest rate changes really signal, and how this affects your wallet, whether you're an investor, a homeowner, or just trying to get by. By the end, you'll never watch a Fed press conference the same way again. The Federal Reserve was created in 1913 to stabilize the American financial system. Its mission? To ensure maximum employment and price stability. Over the years, its role has evolved. Today, it acts as the puppet master of the U.S. economy, pulling levers most people don't understand. The key lever? Interest rates. When inflation rises, the Fed raises rates to cool the economy. When growth slows, it lowers rates to stimulate borrowing and spending. Sounds simple, right? But beneath this logic lies a world of assumptions, models, and silent battles between Wall Street, Main Street, and Washington. What the Fed presents as neutral policy is often guided by politics, panic, or long-term strategy the public never sees. Let's talk about the conflict. The Fed says it's apolitical. But can an institution that literally prints money and controls credit be free of influence? Hardly. Consider the tension between fighting inflation and keeping unemployment low. Raising rates curbs inflation, but also slows hiring. Lowering rates creates jobs, but risks overheating. In 2022, the Fed aggressively hiked rates to tame inflation. But many economists argued the inflation was supply-driven. Rate hikes couldn't fix broken supply chains. Still, the Fed pushed forward. Why? Was it optics? Was it pressure from markets? Or was it a strategic move to cool speculative bubbles? Then there's the messaging conflict. When Powell says, "We're data-dependent," it signals uncertainty. But the market reads every word, every pause, like a stock chart. One misstatement can tank or boost billions in assets. This tightrope act hides just how much psychology the Fed leverages. And you? You're expected to believe it's all mathematical. Here's the insight that changes everything. Interest rates are less about economics and more about behavior. The Fed doesn't just adjust rates, it guides expectations. This is known as forward guidance. Think of it as economic hypnosis. When the Fed hints at future rate hikes, markets preemptively react. Consumers delay borrowing. Investors shift portfolios. It's policy by suggestion. Look back at 2008. The Fed slashed rates to near zero to combat the financial crisis. But they didn't just rely on cuts, they used language. Extended period of low rates. Quantitative easing. These phrases soothed markets, created confidence, and spurred risk-taking. Fast forward to 2020, COVID crashes the economy. Rates return to zero, and asset prices boom. Why? Because the Fed signaled unlimited support. Investors believed the Fed would backstop losses. That belief alone inflated stocks, crypto, and housing. This shows us interest rates aren't just a tool. They're a symbol, a signal, and sometimes a weapon. Let's break this down with real stories. Case number 1. Paul Volcker, 1980s. Inflation was running wild, over 13%. Volcker, Fed chair at the time, did the unthinkable. He hiked interest rates to 20%. The economy tanked. Unemployment soared. But inflation finally broke. His move showed that the Fed could endure short-term pain for long-term gain. But it also showed that interest rate moves are political bombs. Case number 2. Alan Greenspan and the dot-com bubble. In the late 90s, Greenspan kept rates low, encouraging tech speculation. When he finally raised them, the bubble popped. Many argued he waited too long, but others say he was more focused on growth than stability. Case number 3, 2020-2022. Rates went from 0 to over 5% in record time. Mortgages doubled. Debt payments exploded. And yet the Fed insisted it was data-driven. Meanwhile, regular Americans saw their rent skyrocket, credit card APRs rise, and savings erode. The key takeaway? The Fed's moves aren't always aligned with your interests. They're aligned with systemic survival. So, what can you do? 1. Understand the lag. Rate hikes take 6 to 12 months to fully impact the economy. Don't react immediately. Plan ahead. 2. Watch the Fed calendar. Know when FOMC meetings are. Big moves often follow. 3. Decode the language. Transitory. Soft landing. Pause. Learn to interpret Fed speak. 4. Diversify. Interest rate changes affect sectors differently. Utilities may suffer, while banks may benefit. 5. Manage debt. In a high-rate environment, refinancing can be costly. Consider paying down variable debt first. 6. Invest for rate cycles. Bonds drop when rates rise, but high-yield savings and CDs become attractive. 7. Ignore the noise. Media dramatizes every 0.25% change. Focus on long-term trends, not headlines. So next time Jerome Powell steps up to the mic in that wood-paneled room, remember, he's not just reading a statement. He's setting the stage for billions of economic decisions. And maybe, just maybe, you'll understand the hidden message better than the suits on Wall Street. Subscribe, stay smart, and remember, in the game of money, silence is the Fed's loudest tool.